Welcome to the Smart Investing Show, sponsored by the SEC-registered investment firm Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who's been putting client needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello and welcome to the Smart Investing Show. I'm Brent Wilsey, president of the investment firm Wilsey Asset Management. Great to have you here today. As always, we got some important things to talk about to make you a smarter investor. We're going to kick off the show talking about China's population is declining. Why should you care? We'll talk about that. Another history lesson. This one, if you don't listen to anything else, this is one thing you really want to listen to about investing. Another history lesson shows why we do not overpay for hot stocks. You're going to these numbers are just unbelievable. Like, oh gosh, I wish I would have listened 5 years ago. Gold, well, it has done well, but silver, it has surged. Should you buy it now? Well, we got a lot to talk about that, don't we, Chase?
We got a lot on that one. A lot of interesting news here. And also, too, outside of our normal topics, we are going to look at McCormick. I love this company. It's a spice company. I believe they have Frank's Red Hot, and I haven't had it as much lately, but I love Frank's Red Hot. So curious to see what the numbers look like there. We're also going to look at Zoom. Interesting story here with Anthropic. I think you'll find this interesting, as well as Booz, Allen Hamilton, and Pinterest. Those are the four companies we're going to look at, break down the fundamentals, give you an idea if we think it's a buy, sell, or hold based off the numbers we see.
Let's dive right into China's population is declining. Last year's birth numbers for China recently came out, and it was the lowest since 1949. What was the population of China in 1949, you may ask? It was only around 540 million people. So percentage-wise, it was a much higher birth rate than the 7.9 million we saw in 2025. Now, with over 1.4 billion people and about 11 million people dying every year in China, it will take a long time to have results of a large declining population. But the problem with a lower birth rate than a death rate is that it has a major changes for the economy. And I'm surprised to see this. China's, I thought it was much lower, but China's life expectancy is 79 years old.
That is interesting. And I mean, the thing you look at is the population there is getting older, and there are fewer young people working to support the older generation that generally need more medical and social services. And when you look at an aging population, there's generally less need for housing, schools, and businesses because older people have less need for those services, which can grow an economy versus the cost of higher medical demand. I would definitely reemphasize this point. I think I'm going to say the go-go years of your 30s, 40s, 50s, that is really where economies can thrive because you have all these services, all these products. But I hate to say it, but a lot of times people 70s, 80s, 90s, not all 70s, 80s, 90 years old. We see a lot of active ones, right, but there's many that aren't super active, so they're not really helping with economic output the same way that somebody in their 40s and 50s with, a few kids are.
Yeah, if you're in your 30s, 40s, or 50s, you want to go out and have fun, go to restaurants, go to places. You get in your 70s, I'm just about there, just like, maybe you don't need to go out tonight. You just kind of slow down a little bit, and that can be a problem for the economy because no one makes any money when I stay home and watch a movie in my theater.
I guess maybe the Paramount Plus does or whatever streaming service they're counting you as a subscriber.
$12 a month? Yeah. They're making a little bit, not a whole lot.
But it doesn't have the same compounding effect.
Exactly. China also has a problem with immigration, and I knew this one, as they have over 300,000 people leaving versus coming in. So they lose a lot more than they come in. No surprise there. You may be wondering how the United States stacks up. In 2025, we had 3.7 million babies born and 3.2 million deaths in the country. I was surprised to learn that the mortality rate age in the United States is under China's. Ours is 78.4 versus 79. I mean, not a big difference, but I thought, because of medical and everything else here, we live far better. I think, this is just my guess, that they may have less stress in China than maybe we have here, maybe?
I don't know about that. I think, just culturally, and again, I'm not a China expert by any means, but I know a lot of the Chinese are very strict in different things. I was going to say maybe it's probably better health. If you look at the obesity rates in China versus the U.S., I'm just going to have to assume China is a lot better in that rate.
I think you're right. I think we have a lot more McDonald's here than they have over there.
Yeah, and the other thing I was going to say, on the flip side of that, China with all the factory and the smog and the ecological, what's the word I'm looking for? Not ecological, environmental factors. I would have thought maybe that would have had a negative impact there. I also believe China, they smoke a lot there. I might be confusing that with Taiwan, Cambodia, those kind of other Southeastern Asia countries.
I think you're right. I think the Asians still have a higher smoking rate.
So, I mean, it's close. I mean, 78.4 versus 79, but I think the reason ours is so close is, again, the obesity is much different here versus China. The other thing I always point out with China that I find very interesting is China, I mean, they always talk about their 2050 plan. They're so long-term thinking. I mean, I've said this before on the show, but when they came out with the one-child plan, it's like, that's not a long-term thought process. And that has really put their economy, their country in a dangerous spot where their birth rate is less than 1 versus their, death rate. That is not a good spot to be in. And I think that is going to be very hard for that country to come back from over the long run.
And I think what they were trying to do, unfortunately, was they were trying to have more boys born than girls because boys can, work, produce, and so forth, and women. And this one didn't make any sense to me because, women have the babies.
Yeah. I don't know. Obviously, we weren't in the room. We don't know why they did it.
Yeah.
I think part of the reason this is just going off trying to recall history lessons, but
it was many years ago.
I think it was, they were having such large population growth. It was hard for the country to really have that many people coming into the country and take care of a society that was that big. So I think they tried to limit the growth, but then it really hurt them in the long run, I think.
Yeah, the growth rate was too high of people, and they couldn't keep up with it, so they reversed it too much. They should have maybe done 2 babies. I don't know.
Yeah, I don't know. Or just not put a cap on it because not everybody has a baby either. So that's the other issue. But looking here at the United States, I mean, we do know with all the illegal immigration, the heightened status of what is going on with immigration in the U.S., it is hard to come up with a concrete number for comparison purposes. As you said, the 300,000 net negative in China, we know it's a lot different here in the U.S. as people do want to come to the U.S., and that really can help support a low birth rate and, again, continuing to grow the population.
Yeah, and there's things you can do that. And, again, I think we'll go back to, hopefully, maybe next year, we'll be back to more normal immigration here in the United States because it got so far to one side a couple of years ago. So now you got the opposite, what's going so far to the other side to kind of clean up the mess, I'll say. But we will get back to normal immigration because we do want people coming here. We do want good people coming here to work and, be scientists, workers. And I mean, we need that, but we need to get back to a level playing field where say, okay, now let's have some people come in that they can really help our country here.
I mean, good immigration is in that positive. You have more money coming into the economy. You have more people working, producing. I mean, it is good to have more people as long as you can handle that influx.
Yep, and I think we will get to that. Well, let's talk about another history lesson shows why we don't overpay for hot stocks. And I've been doing this for about 45 years now. And it's always made sense to me, and I try to tell people. And the thing is, it doesn't happen in 2 weeks or 3 weeks. We're talking now about a 5-year time frame that this actually showed up. And people thinking, oh, yeah, I'm so smart. Well, let's talk about what we're talking about here. We know it's exciting to be the next hot thing on Wall Street, but that was the same way people felt just a few years ago with hot software companies like Salesforce, Adobe, and ServiceNow. Looking back, many of these once hot companies now have seen very disappointing 5-year returns. As an example, Salesforce is only up around 1% for the last 5 years. And that doesn't mean, too, because if you bought that stock, I'm going to say a year ago, you're actually negative. So we're talking about a 5-year return, just about 1%. But another one here, too, that's over 5 years. Adobe, I was shocked on this. Adobe actually has fallen 35% over the last 5 years. And Adobe was a hot name, like, oh, wow, you can't go wrong with Adobe. Well, 5 years ago, you're down 35%. You've lost a good amount of your money.
Yeah, and the interesting thing is you kind of bring up, the way people kind of view investing in these. And Adobe and CRM or Salesforce, they're both up well over 200% over the 10-year period. Mm-hmm. And so, again, congratulations, I guess, if you bought it 10 years ago. But the problem that many people have is they'll buy it, and they're like, yep, see, I was so smart. I made all this money. And then they put more money to work in it, more money to work in it. And now your incremental kind of investments are underwater. And now your net gain might be neutral or potentially down, depending on when you invested in these names and added additional funds. So, I mean, that's the problem. Or the other big problem is it went way up the first 5 years in that 10-year period. And people are like, oh, wow, I got to get into the hype. And that's exactly what happened. Remember SaaS, right? Software as a service. That was the name. That was what was hot. And then, people pile into it. And now those people that invested 5 years ago, they've done very, very poorly. And the thing we always tell people, we won't overpay for earnings on high-flying companies because many things can change, like we have seen in the software industry. Software companies were supposed to benefit from AI. I remember hearing this 2 years ago, CRM, Salesforce, Adobe, they were going to be big benefactors of it. But now we look at Anthropic's Claude Code as an example. That's an AI tool. It says it can shrink the time it takes to actually build complex software. So, some people are saying, well, I can now use AI to maybe create my own software company. And again, I'm not a tech person, so I don't know the exact mechanics behind this. But I do know, as you said, competition, new entrants here can be problematic. And I think that's what we're seeing. And I did see, I don't know how it works, but on CNBC, they showed, I guess with this Claude, they just typed in Microsoft Excel, build me a analysis for Google or Alphabet, and it went through and had the sensitivity analysis, and that's all you had to put into the Excel spreadsheet, and it produced all of this information. So, I mean, it's pretty impressive what the technology can do there.
And I do remember a couple of years ago, and I don't remember the gentleman's name, that's the CEO of Salesforce, but he was on CNBC talking about, yes, AI, we're going to do this and that, this is going to grow the company, blah, blah, blah. Wow, he must have been surprised now.
Oh, yeah.
Well, also, in addition to that, new competition can come from startup companies that can slowly take away market share of the older companies, and sometimes just a little bit at a time. And before you know it, it's been 2-3 years, they've lost some market share. Unfortunately, some of the software companies began to borrow substantial amounts of money and now have highly leveraged balance sheets, which could cause problems, even more problems in the future for some of these software companies.
And I look at kind of Adobe as an example, and I don't know necessarily everything that Adobe does, but, Canva was actually a new entrant into kind of not necessarily the PDF space, but really kind of creating marketing materials. And that's really where I think a lot of people used to use Adobe. So there was that new entrant there, or an extreme example, right? We've talked about this before, about how hot Intel was. Well, then NVIDIA came along, and they were now the top dog. And the problem is, when somebody's the top dog, like NVIDIA is now, nobody wants to think that somebody else is going to come in and knock them off the throne. But obviously, we see it time and time again in history. And kind of back to your point about the leverage balance sheets, in just the last 24 months, 13 software companies have defaulted on loans. I don't think many of these big software companies, again, Adobe, Salesforce, Workday, I don't think they'll be out of business anytime soon, but I also don't believe their stock will run up to the level seen in the past anytime soon. And I will say some of these companies, Adobe now trades, I think, around 10, 11 times earnings. Pretty darn attractive based off the valuation. But like ServiceNow, I think they're still in the 30s. There's still potential growth there. But the valuations on some of these still aren't attractive.
I know when we saw this, we talked about, maybe we should look at software companies. And unfortunately, we didn't pick one for today's show, but maybe next week we should, because maybe there's now some value there. And it won't take us, and see, if you paid, I'm going to say $100 a share, it's now $50, you need 100% return to make that back even. But if we buy it at 50, gosh, we'd be thrilled if it goes to 60. That's a 20% return. We would love to see that type of return.
Oh, absolutely. And one other last point I wanted to make on these software companies, there's a gentleman in Barron's, he was talking about stock-based compensation.
Oh, yeah.
And I loved this point because a lot of times people back out stock-based compensation from earnings, and a lot of these software companies have. So if you're looking at buying these companies, make sure you're looking at that component. And the reason it's so important is because it's not really an expense. You're just issuing shares, and that is dilutive, but that does kind of get accounted for in the long term because the outstanding shares should be rising anyways. But the downside is, with the stock being down 50%, are you gung-ho as an employee about being paid in stock-based compensation? You basically just got a 50% haircut in your compensation. So now what happens is people say, no, I don't want stock-based compensation. I want dollar compensation. Yeah. And then those expenses actually start to flow in now to the income statement. So that is one thing I would be looking at if you hold these software companies. What is that stock-based compensation? Because that could really change earnings over the next few years.
And it's so important to understand these things because investing, people say, oh, it's easy. It is not easy. You look at all these things, the stock-based compensation, the fundamentals of the company. There's so many things. In short term, anybody can guess, and roll the dice. But longer term, you've got to understand you're investing in businesses. You have to understand that business, how it's operating, because it all comes down to eventually the earnings that that company is making. And that's why we spend many hours, sometimes 10, 15, 20 hours looking at a company before we invest into it, because we don't want to be blindsided like, oh, shoot, we forgot about the stock-based compensation. Now they want cash.
Yeah.
You know, and as you said, what employee would say, yeah, give me more of that stock that's going down in value?
Yeah, and it could make sense, but people don't think that way oftentimes.
No. So, well, let's talk about, let's see. I think we
Gold.
finished. What's that?
We have gold. Gold and
gold.
silver.
Oh, gosh. I knew we weren't done. Gosh, yeah, the gold and silver. How could we forget that shining thing here? Gold has done well, but silver, well, that has surged. Should you buy it now? I'm sure people thinking, yeah, I want to get in. I want to get in that silver trade. Silver is now up almost 200% the last year alone, as it has become immensely popular with retail investors. Many investors are excited to point out that silver has a strong use case as an industrial metal. It is a key component in electronics, including circuit boards, switches, and solar panels, thanks to the fact that it's an excellent conductor of electricity.
Yeah, and thanks to increasing demand for areas such as EVs or electric vehicles, and also growing electricity needs, largely due to the AI push, industrial use cases now account for around 60% of demand. This does compare to under 50% just a decade ago. I was also surprised to learn that silver may be subject to supply shortages. About 3/4 or 3/4 of new silver is actually created as a byproduct of mining other metals like copper, zinc, and lead. So it's not even people mining directly for silver. This has led to silver demand outstripping supply every year since 2018.
And things will change. And while this all sounds positive, generally markets have a way of reconfiguring the supply and demand equation. I believe this could lead to companies that have silver as an input cost will instead look for other sources, alternative sources, as the price has become prohibitive at the recent surge has happened here. This would hurt demand for silver. So things change. And this is what people don't realize. You can't invest in something thinking that because it did this over the last 6 months, it will go that for the next 6 months. Things change because it's, especially when demand, people say, oh, well, silver is better than gold because there's a demand for it. Yeah, there is, but that demand will change as prices go up.
Again, 60% is coming from use cases, and people might point to that as a benefit and why we should be buying silver. But as a business, if you have a cost of a product or an input cost, I should say, go up 200%, that could all of a sudden wipe out your profits. Either one, you might have to stop producing a product because it's no longer profitable, or two, you're going to say, could I use a different conductor of electricity? And that's 60% of demand for silver all of a sudden gets reduced. That could be a big, big problem. And then on the other side is the supply side. And since the economics of finding silver is strong at this time, you could see more mining for silver and, again, those other metals. So you could actually have a glut maybe of copper, zinc, lead, because people are going to say, I'm going to keep mining for these because I find silver and I can sell it at such a great price. So, again, you could see that increase the supply of silver. Not to mention, I don't know the accuracy behind this, but, people have talked about, should I melt down my silverware? The thing is, the spot price of silver, you might not be able to get that. But if that truly was the case, and my fork that I bought for $2 is now worth $10, yeah, I'm selling my silverware set.
Right.
So this creates declining demand and increasing supply, and that would obviously be problematic for the price of silver.
And also, too, I mean, the commissions that I've seen on commodities is always very high. Or you might go to a pawn shop. I mean, you're not going to get that. Well, it was 125. Big pullback yesterday on silver. I think it was down 20%, was it?
No, 25. Yeah.
25%. So it's just like, oh.
I was going to say, it's funny so we initially did this post on social media. I think we did it on Thursday. So the 1 year gain on silver was like 260%. And this is what people don't understand about compounding, right? Is it makes bigger numbers bigger, right. But also when that decline happens, those bigger numbers get smaller faster. So the 1 year return on silver, and it was adjusting throughout the day, so we kind of rounded at the 200% gain. The 1 year is now 162%. So we went from over a 250% 1 year gain to now 162% 1 year gain.
It almost sounds like 100%. It's not 100% loss, but a decline of 100%
in your profits.
In your profits, yeah. And that scares people. And they're like, oh, I better get out. It's over. So we'll see what happens on Monday. But, and again, this whole run-up, I think, happened very quickly and for no reason. And I think Could this be the end? This is what we've been talking about for weeks, if not months. So you got to be careful with these commodities.
Yeah, and there was a commodity expert analyst on CNBC, and they called it the memization of precious metals.
Like meme stocks?
Yeah, with gold and silver, these quote unquote conservative assets should not be seeing gains of 70, 200% in a year. That is
25% a day.
Yeah, that is not conservative investing. That is no different than Bitcoin or cryptocurrencies. I mean, it's almost worse.
And actually, I did hear that. I think gold last 5 years had a better return than Bitcoin did the last 5 years. So things are kind of changing. So I tell you, be careful. Another way to look at the value of silver is the silver to gold ratio, which tells you how many ounces of silver you need to buy 1 ounce of gold. The 50-year average is around 65 times, but today that ratio has fallen to below 60. That's the lowest ratio in over a decade. Ultimately, your guess, well, like I say, is as good as mine for where the top for silver is, but long term, I don't believe we'll see strong results from this level. Big returns on silver. I think the end could be near.
Yeah, and again, since silver fell so much more than gold, that ratio was actually below 50 prior to Friday, and then it flipped very, very quickly. So things can adjust. And again, you got to remember here, this is a volatile asset with other historical instances of massive rallies that were followed by large declines. We have talked about the Hunt brothers' attempt to corner the market in the 80s, but more recently there was a bubble that occurred in 2011. The price peaked at around $49 in April of that year, but quickly tumbled about 25% in just a week. Kind of funny, we had that 25% decline in just a day time around. But it may not always be a buying opportunity, as if we look back to 2011, it ultimately ended the year at $27 for a total decline of nearly 45% from the high. So again, we could see silver topped around, I think, 110. If it goes down 50%, I mean, you'd be right at 55.
Damn, I think I missed the boat. I was going to go tomorrow to the pawn shop and unload some of my silverware, but I guess I won't do that now. All this information does come from our newsletter. It's a free newsletter, goes out every Friday at 4 o'clock. If you want that newsletter, go to our website, smartinvesting2000.com. Again, that's smartinvesting2000.com. Other topics on the newsletter, teaching and investing in school, well, it sends the wrong message. We explain why. The housing market dilemma is still there. Don't brag about your gold investments. Probably not easy to do now after yesterday's fall there. The new Federal Reserve Chairman will not make much of a difference for interest rates. You got to read that one because it really helps you understand more about the Federal Reserve. And don't look now, but your health insurance premiums could be going up soon and going up a lot. And then the secret formula, I know this is a kind of a fun story. The secret formula for WJ40 still remains a mystery. You got to read that. It's very enjoyable. Again, go to our website, smartinvesting2000.com. Again, smartinvesting2000.com. Right in the middle of the page, I think it is. Sign up for that newsletter. So, all right, you want to talk some companies here, some stocks?
Let's do it.
Let's do a spicy one. McCormick and Company. I just like this type of a company. Because it has, I think they have pepper and spices. You said the red hot sauce, and
Frank's Red Hot. I forget they have Cholula too. Two of my favorite hot sauces.
And I don't have anything hot, so I don't know much about it. I just know they have pepper.
Yeah.
So their symbol is MKC in the packaged food industry. Only about 4.4% short on the float side. We do see about 93% institutional owned. PE ratio, not a good start here. It is 21.1 versus 19. Price of sales, 2.4 versus 1.1. Price of book value, 2.9 versus 2.2. And price of cash flow, 17.3 versus 10.3. So these valuation ratios, you want them lower than the industry. And unfortunately, that's not the case so far with McKesson or McCormick here. We do see a PEG ratio, 7.7, not a great deal, but the industry is at 72.2. The earnings over the last year were up 0.3%, but the industry, I don't know what's going on with the industry, it was down 17.9%. Sales climbed 1.7% over the last year, not as good as the industry, up 4.4%. They do have a 5-year earnings per share growth estimate for the analysts at 2.8%, about half the industry at 4.6%. Now, they do pay a dividend, nice dividend, 3.1%. They use 61% of their earnings to pay that out, so that looks pretty sustainable there. Not any big cuts coming soon that I can see. The balance sheet, current ratio, a little bit low, 0.7 versus 1.4 for the industry, so kind of a little bit of problem with the liquidity there, but the debt to equity is not bad at 0.7 versus 1.6. So low debt, but low liquidity as well, not a good combination. We do see the net profit margin is 11.5%, very good compared to the industry at 4.6. Return on equity on the light side, 13.8 versus 25.3. We like to see about 15, so they are low there. Free cash flow is looking light also, 740 million, I believe that is, versus 3.9 billion for the industry. So I'm not too excited about you might just be having your hot sauce on there and not be buying the company.
Yeah, I was going to say, they got some other good stuff too. They got French's, which...
the mustard?
The mustard.
Oh, yeah.
Yeah.
I don't like that either.
Oh, I love mustard. It's one of my
I
favorite.
like plain food.
They got some of my favorite condiments, and they have Stubbs barbecue sauce. That's a pretty good barbecue sauce. I like that one too. So they got some
too
good
sweet.
stuff.
Too sweet for me.
You're just so hard to please. You like, though, the McCormick, the salt, pepper, they have different seasening blends.
I used to like, I forget what it was. Mrs. Dash, I think it was.
I
to
don't
love
think
that
they have that one. I don't know.
Shoot.
But looking at the numbers here for McCormick and Company, again, their ticker symbol is MKC. It's $61.83. And, we gave software companies a hard time, but the falls can happen for companies that aren't inside tech as well. The 1-year return for McCormick, down 20%. The 5-year return, down 31%. I mean, this stock has really had some difficulties. That doesn't include the dividend, though. I mean, that's one nice thing about dividend companies is it does cushion the blow when the price declines. Because what's your 5-year return on? Do you have it on?
Yeah, let me take a look at that for you. I wasn't looking at that.
While you're pulling that up, I'm going to go forward and look at those valuations.
Down 24.7.
Okay, so I mean, it cushioned the blow a little bit, not too much, though. But looking forward to this company, November 2027, estimated earnings per share $3.33 would give us a target sell price of $55.28. I mean, it still trades at 18 times earnings, even with the fall. That means this company was probably trading in the mid-20s, maybe the 30s in terms of multiples. That's why you don't overpay for businesses, whether it's in software, technology, or spices.
Yeah, and it seems to be that it got well ahead of itself. And again, I like this type of company. What was the target sell price? It's not
55.28. Traded at over 18 times future earnings.
So still not a buy for us. No, still not a buy. But I like this type of company. It'd have to go down a lot more. Maybe I'm going to say
probably not a 30-ish%, I would assume.
Yeah, I was going to say 20-25% because it's a good basic company. It, works pretty well. But for some reason, somehow got on the hot stock trend, and everybody's buying it and pushing the price up beyond what the value of it was. So we're going to slap a do not buy on that one for now.
Yeah, we need it to fall exactly almost 30% to hit that metric and maintain the same target sell price.
And I guess when we say a do not buy, we mean sell as well.
Yeah.
Yep.
Yeah, unfortunately. Maybe
All
buy
right.
their hot sauce, but not the stock.
There we go. All right. When we come back, we're going to be talking about the Zoom, Booz Allen Hamilton, and Pinterest. Stay with us. You're listening to Smart Investing Show with Brent and Chase. We'll be right back. All righty, welcome back to the second half of the Smart Investing Show, and this is when we talk about financial planning with our financial planner, CFP Harrison Johnson. Harrison, glad you're here.
Glad to be here.
Talking about best accounts for kids and grandkids. Are we talking about giving kids money? I don't believe in that. I think the kids need to work for it, go out, cut the grass, do these things. Come on.
So this is a question that I get from people. Oh, I have a grandson. I want to, start an account for them, or, I want to set something up for my kid. So it's something that I get asked fairly often. So I wanted to address it, and then we can also talk about the merit of whether you should do that at all. But a couple different accounts that you have options are, so there's 529 plans, there's custodial Roth IRAs, there's these newer Trump accounts, there's custodial brokerage accounts, the UTMAs or UGMAs, or there's just, having money in your name and then, gifting it to kids if that's something that you decide to do. So with a 529 account, money grows tax-free if you use it for education, but if you make a withdrawal that's not for education, you have taxes and penalties on the federal and state level on the earnings portion of what's in that plan. Now, there's a relatively newer rule where you can roll some of that money into a Roth IRA without federal taxes and penalties, but many states still will tax and penalize that. So the state of California will tax and penalize you on the earnings if you do that Roth IRA deal with the 529 plans. Roth IRAs, so you can open up a custodial Roth for a child, but you can't make a contribution for them, or they can't make a contribution either if they don't have earned income, which most young kids don't have a job. So that's something that a lot of people just can't do. The Trump accounts that's relatively newer, they function essentially like a after-tax traditional IRA. So money is contributed to them after tax, and then the earnings grow tax deferred, but when withdrawn, the earnings portion is taxable at ordinary income rates. So with those accounts, the kids can't touch the money until 18, and then at 18 they can, but they still have a penalty until they're 59 and a half. So it's kind of like a retirement account, but there are better retirement accounts, I think, because again, with these accounts, it's funded with after-tax dollars, and then the earnings is also going to be taxable. Custodial accounts, those, are investment accounts, non-retirement investment accounts of the name of a child. The earnings, capital gains, dividends are taxable to the kid instead of you. However, the kiddie tax, what's called the kiddie tax, applies to that, which basically means a kid can have up to about $2,700 a year of investment income taxed at 0%. So although it's, reportable income, it's not a tax deferred account. It kind of is, because the income isn't actually taxed depending on how much they have. And then lastly, just it accounts in the parent's name. And this is usually the one that we gravitate toward, because it gives the parents or grandparents control of that money. The downside is if they have any earnings of that, capital gains, dividends, interest, that's taxable to the parents or grandparents, but it makes sure that they can help the kids, when they want, how they want, and because a lot of these other accounts, once the accounts belong to the kids, they can really do what they want with it without, that much control.
And I did want to say, we've talked about the Trump accounts before, and people have, I'm going to say, rightly corrected us, but we just didn't really talk about it. The strategy behind the Trump accounts, if you do fund them, is when that kid turns 18, you can do a Roth conversion, and the kid shouldn't have much income at 18. So there is a potential use case for it. But again, I want to circle back now to what Harrison brought up about keeping control of that account. That is why I do believe it's not the best thing to put money in your kids' accounts. Is when they turn 18, I hate to say it, we see it all the time where people, they just burn through it. I mean, we've seen people burn through $100,000 in a year when they had no business burning through $100,000. And frankly, the parent gives the money to that kid. As the kid being our client, we can't tell the parent, yeah, your kid burned through $100,000. It's like, no, you got to ask your kid what's going on with the account. It's not in your name.
And I guess that's why I'm a little bit, a little bit concerned on it, a little bit timid on it, where I think if you don't earn something, work for something, you don't appreciate it. I've seen people get, and especially now, timid, we manage about $800 million, about 3,000 clients, I guess, but 2,000 accounts. So we've seen things that it's just human nature. You're 18 years old. You really have not developed any. And not all kids. There's some kids out there, 18, that are great kids, but other kids like, wow, I got $20,000. I'm rich. I can do whatever I want. I don't need to work. I got 20, and it's just such a shame. And that's why I like accounts. I did that for you and all my kids, was I kept control of the money. So if you want something, we'll take care of it. But I really made all four of you work for things, not just give you something.
Yeah, and I mean, Chase, you have two daughters. I'm about to have a son in about a month and a half. So I mean, I'm not planning on opening up any special accounts for them. 529, I'm not going to do that. Trump accounts, I'll take the $1,000, but that's coming. But I'm
sit
not
there for 18 years.
I'm not. Yeah, I know, it's something I just have to watch for forever. But my plan with my kids is going to be, I'll fund my own accounts, and then I'll see how, hopefully I can, be a good parent and help them out and everything. But I think the control of being able to help at the right time in the right amount for the right things is, extremely valuable. And a lot of people discount that. They look at, oh, well, I want to use this custodial account because it's for them, it's in their name. But again, once you make that contribution to that 1-year-old, it's really their money. And then at 18, the account belongs to them. So if they want to go, do something else with it, that you can't really. Yeah,
they want to go buy a new Corvette. Hey, thanks, Dad. I appreciate the new Corvette. Like, no, that's not what that was for.
Right.
And I think the other problem is a lot of these accounts, they do come with tax benefits. So you are foregoing some tax benefits in the name of control, but a lot of people don't utilize the accounts right anyway. So the tax benefit over 18 years might amount to be, and I'm just going to throw out a number here, like $2,000.
Right.
To me, over 18 years, losing out on $2,000 of tax benefits is far worth it to keep control of the money and being able to disperse it when the time comes and when the kid is, I think, deserving of it.
Yeah. I mean, if you fund an account in your name, and that's also not talking about like if you're not maxing out your own retirement accounts, that's something that you want to be doing before you're doing anything for your kids, because your own retirement accounts are going to be more tax efficient and less restrictive than anything for them. But if you are doing that and you put money into a taxable account, a brokerage account, capital gain and dividend taxation is flexible. You can choose when you want to sell. You can realize how much you want to realize. The tax rates are less than ordinary income. So it's not as if you're paying a whole lot more, giving up that control.
And I think, if you tell a kid, maybe once they turn 20 or 30, I took care of you during your infancy to when you were 18 by giving you money and foregoing my retirement. So when I retire, you need to take care of me. I think most 20, 30 years would be like, no, why'd you do that?
I've got a mortgage. I've got a kid. I can't take care of you. You come live with us, but you live in the closet.
It's like, I gave you money, now you got to give it back. It's like, why didn't you just give it to yourself?
And I guess the important thing is here is that whatever people want to do, there are ways to put money away for kids, and it depends on what you're doing. And the thing I will say too, and then we'll wrap it up, is that you don't know how 1-year-old is going to turn out 18 years from now. Mm-hmm. That's the big guess. And
hopefully they all have high hopes. Yes,
we have high hopes. Hope for the best. But sometimes things, they get around the wrong friends or whatever, and they go through a difficult time. And then by the time they're 30, they wake up. Yeah. By that time, money's gone. So, but again, options for people.
There are options. Yep. All these accounts are different. Sometimes they work, in different situations. But that's what I wanted to bring up.
Great. Well, Harrison, thank you very much. We appreciate it. Again, that is Harrison Johnson. He's a CFP. He's the financial planner for Wilsey Asset Management. If you want to contact him, give him a call at the office, 858-224-0004. Again, that's 858-224-0004. Or go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. All right, should we zoom in on Zoom here and see what's going on with that company? That was hot during the COVID.
Oh, yeah, I'll get into the price action there when we get into it here. But, some interesting numbers for Zoom, to say the least.
All right. Zoom, again, their symbol is ZM, software application. Ooh, another software company. Only about 2.5% shares short on the float side, 77.6% institution, means there's a fair amount of people that hold it directly. PE ratio 17.9 versus 43. That is good. Price of sales 6 versus 5.2. Yeah, that's okay. But price to book value is good, 2.9 versus 5.1. And price of cash flow is good as well, 13.9 versus 22.4. And a decent PEG ratio of 2.3 versus 2.8. And again, that shows what you're paying for the future growth of a company. Wow, their earnings for Zoom were up 70.8% over last year, well above the industry at 16.3%, but sales didn't match. Sales were only up 3.8% over last year for Zoom. Industry was up 7.8%. The 5-year earnings per share growth estimate is 7.5% for Zoom, half the industry at 14.4%. Unfortunately, they do not pay a dividend. Look at the balance sheet, current ratio very good, 4.5 versus 1.7. Debt to equity is 0. No debt in the balance sheet. The industry is at 0.5. We do see a very good, they need to reduce their costs that we pay Zoom, because their net profit margin, 33.2%. They make a third of our revenue, profit margin. That's pretty good. We do see return on equity 17.2 versus 21.3. Free cash flow is $2 billion versus $3.4 billion for the industry, so that's okay. I don't know. I guess it depends on what's going forward, if I like this company or not.
I'm going to start with the positive here, and Zoom maybe is in the wrong business. Maybe they should be in the private equity realm. It looks like Zoom popped 11% on Monday after Baird pointed out the company's investment in artificial intelligence startup Anthropic could be worth between $2 to $4 billion. It looks like in May 2023, Zoom revealed that it had invested in the company. The companies did not disclose the value of the investment, but Zoom reported making $51 million in strategic investments that quarter. It is assumed most of that went into Anthropic. But again, the startup is now currently valued at $350 billion, suggesting Zoom could see a return of roughly 78 times on that investment. So that was a big positive for them. Obviously, having $2 to $4 billion in this asset on their balance sheet would be beneficial. But the thing is, it's not really a business asset, right? That's not a reason to buy Zoom, because if you liquidate it, or let's say Anthropic goes down, it's not really improving the business operations, which is what you want to think about when you're buying a business long term.
Yeah, I was going to say that, because there's not cash flow coming from it. There's not earnings coming from it. It's an investment that they hold, and congratulations, do very well. And I don't think we ever looked at Anthropic. I mean, I don't know what their numbers look like. Is it worth 70
Oh, we
billion.
can't look at Anthropic. It's
It's
a
private.
company.
That's right. It's
Yeah.
private. That's
Could be
what-
going public this year, potentially,
Yeah.
maybe next year. But
That'll be one of those high flyers, I'm sure.
Oh, yeah.
So, and that valuation, it could be good or it could be overdone. But again, right now it's benefiting Zoom, I think is what you're saying.
yeah, I mean, it benefited Zoom because it was kind of a positive surprise, to say the least.
Yeah.
And I mean, it does help because it obviously lifts Zoom's assets, but it's not going to improve earnings and cash flows.
Was it up a lot on Friday or when did this come out?
Monday.
Monday.
So it looks like their 5-day return, it kind of fizzled out. It was only 3.94%. You look at the 5-day chart, it goes, whoa, zooms way up on Monday and then kind of
back.
fizzles out. But talking about fizzling out, let's look at the current price here for Zoom first. $92.10, 52-week range. That looks pretty good. The low here, $64.41. The high, $97.58. The 1-year return, nothing special, up 5%. But the 5-year return, ouch, down 75%. And you want to talk about a massive decline. And again, why you don't get sucked up into the hype of something. The all-time high for Zoom occurred on October 18th, 2020. Any guesses?
I would say 500.
Close. $588.84. So
Wow.
it is.
And it's at 90.
92. Yeah, that's rough.
And I got to say, it is kind of surprising because Zoom, we use it. It's very well known. But I guess even though they charge a 33% for the net profit margin, they still don't seem to be making much money.
I mean, they're doing fine. It's just, again, another example of a good business that just was assumed everybody was going to stop meeting in person.
Yeah.
And it still has a function. Obviously, we use it, as you said. I know businesses use it, but that mass adoption never took place. And that's why you can't assume that when you're investing in something and why you can't chase the hype, because once it fizzles, it can fizzle quick.
Yeah, and I still, people say, can we do it virtual? We can, but it's so much better to be in person. You get so much more in person than trying to go through a Zoom.
Oh, absolutely. I totally agree with that. But again, I'm going to say it's a nice supplement. It's a nice tool. I just had a Zoom with some clients in Arizona. So, you can't always do it in person. So it did, I'm going to say, shrink the world in a way that benefits us in business. So, I mean, it has its purpose, but it again, didn't displace human interaction as I think people anticipated.
I know we got a potential one with somebody up in Seattle, I think, next
Yeah.
week. So, I mean, there's a need for it, but if possible, I'd like in person.
Oh, totally. I mean, it definitely helps, but I think it was a big benefit. And I was going to say, you remember during COVID, the saying, the new normal?
Yeah.
It's like, no, this is not normal.
No, well, this is not going to last. Yeah. People are human nature. They want to be in contact with people.
Yeah, well, now let's get back to the numbers here. It went on our little side tangent. But looking forward for Zoom here, we go to January 2027. Estimated earnings per share here, $6.06. That would give us a target sell price of $100.60. So it would be a hold based off the valuation here. I'll tell you, I would not be buying at these levels. I mean, it's close to its 52-week high. It is close to, again, our target sell price. I mean, maybe on a pullback it'd be interesting, but I just think it is also too singular. I don't know if I'd get into a business like this because of, it reminds me of like a GoPro. Remember how hot GoPro was?
GoPro's another hot one.
I mean, something could come in here and just totally wipe this business out.
What was that number you gave again for the 1 year earnings?
For January 2027, $6.06.
Okay, there's something strange here because I'm using we use Stock Rover.
Yeah.
Stock Rover for January 2027, 10 analysts. Do you know how many analysts? there are?
30.
Okay, so they only showed 10. So I got $3.55.
Wow, big difference.
Big difference, yeah. So, but again, you got 30. I kind of like that number better.
Yeah, and I mean, the only thing is, is there stock-based compensation that maybe some analysts are factoring in? So, I mean, there are other considerations here, but I think no matter how you shake it, I wouldn't be buying Zoom at these levels.
Now, what's funny is that 2026, there's 29 analysts, $5.97 from Stock Rover.
Yours is $5.97. Mine's $5.97 too.
Yeah, so for some reason, we're missing about 20 analysts from 2027. But even so, still not a buy, unfortunately.
And we'd be shifting out to 2028 here in about a month or so. But still, that number is still about 15 times those future earnings. I mean, that's the thing. The earnings growth now is very subdued. This year, looking for earning growth of 7.7%, but next year, just 1.6%. The following year, 3.3%. So, I mean, this company is not going to garner a above-market multiple with very limited growth.
And this, I think, would be another good business if it went on sale. Because, again, it is needed. People use it. They're making money. But it's just still got that hype behind
That's
it.
where I don't even think I'd buy it. As I said, I think it
Oh.
could be a GoPro 10 years, 20 years from now.
I don't know. I think it'll still be around. I think if I get it for $50 or something, I think it'd be pretty good.
Maybe.
Yeah. All right. I guess we'll move on to that one. I like the name of this company. I don't know why. It just has a strange sound to it. And I thought it just used to be Booz Allen, but now I guess it's Booz Allen Hamilton. I guess Hamilton came along afterwards. And I don't. What is this company? How do you describe them? They're a
consulting firm,
yeah.
I guess is the best way I could frame it.
Yeah, that's the industry they're in. I didn't know they have an industry called consulting services. That's where they're at. Booz Allen Hamilton. Their symbol is BAH. As I said, they're a consulting services industry. 9.2% shares short on the float side, so that's a little bit high there. We do see a good start. PE ratio is 13.1 versus 14.5. Price to sales 1 versus 2.2. Price to book value is high though, 10.4 versus 6.8. And then price to cash flow does look good again, 10.7 versus 15. They have a very good PEG ratio, which is price earnings divided by growth, of 2.2 versus 68.8. Over the last year, their earnings are up only 0.6%, but the industry was down 2.6. And sales for Booz Allen Hamilton, sales were down 3.1% for the past year when the industry was up 5.1. They get a 5-year earnings per share growth estimate for the analysts of 7% going forward versus 2%, so that's a positive. They pay a pretty decent dividend, 2.7%. They only use 32.5% of their earnings to pay that out, so that's a positive. Look at the balance sheet. Current ratio 1.8 versus 1.3. That's good. Shows some liquidity. Debt to equity not good. 4 versus 4.2. So this is a high debt industry. I'm not sure why off the top of my head.
Maybe low equity. I mean, if you think about
Consulting, no assets.
Yeah. Asset light.
Yeah. So I would still like lower debt though. And I guess then it would depend on the cash flow. We do see, let's see, net profit margin 7.4 versus 8.8. That's okay. Return on equity, I think you're right, 81.3% return on equity, so probably very low equity. We do see also free cash flow is $933 million, just below the $1 billion that they have in the industry. So what do you got going forward, Chase?
Yeah, so current price here for Booz Allen Hamilton, ticker symbol again, BAH, $88.42. The stock's been under pressure, 52-week range, the low here, $79.23, and the high, $134.27. Over the last year, the stock is down about 31%. Over the last 5 days, it has shed 13%. Had some negative news for the company come out earlier in the week. They did shed, it looks like, about 5% as the Treasury Department said it canceled all contracts with the company whose employees, this would be not good news, leaked the tax records of President Donald Trump and the billionaires Jeff Bezos and Elon Musk to media outlets. And I believe this did happen a couple of years ago, but now the Treasury is responding to that. As it said, it has 31 separate contracts with Booz Allen Hamilton totaling $4.8 million in annual spending and $21 million in total obligations. So that amount really shouldn't be problematic, but I think it's more the reputation. What other contracts do they have with the federal government? Can they wipe out more of those contracts and hurt their revenue? And also, too, I mean, Jeff Bezos and Elon Musk, I think, are people I would not want to piss off.
No. I mean, they got some money to pay attorneys, good dollars. And obviously, this was some individuals. I don't know what they were thinking, but it happened. And where it ends up, I don't know. And I don't know if you're going to talk about, again, another company, the 5-year return. You see the 5-year return on this is?
I did not know.
1.3%.
Yeah.
Another one. Yeah. Well, you got more to give on the earnings going forward, so let's talk about that, and then I'll give some comments.
Yeah, so target sale price for this company, we got to March 2027, estimated earnings per share here, $6.27. We get a target sale of $104.08. I mean, you're paying still over 14 times the future earnings of this business. I was kind of hoping with all that negative news, you might find something trading around 10 times future earnings. But again, 14, I don't think that level is worth the risk here, as there could be some negative contract announcements that come out stemming from the Treasury decision as well that could push the stock lower. And that's generally when you like to buy things. It sounds kind of funny with after all these cancellations potentially, if the valuation gets attractive enough, well, then some new CEO comes in, they fix the company, they get things going in the right track, then you get a readjustment on the valuation. But at 14 times, I don't think it's worth the risk.
Something about a consulting company just doesn't excite me because it's such an intangible.
Yeah.
You could be great today and the dog tomorrow, which obviously happened with them. And I think it's very hard to project out future earnings for this company. So I don't think that I can remember I've ever held a consulting company in the portfolio. I'm not sure I'd ever want to.
Yeah, I mean, that's a great point. I mean, it's kind of like our business where, you could have the advisor, but if the advisor leaves or if the consultant leaves, well, the business likely will follow them. There's not as much allegiance potentially to the company than there is the consultant.
Yes. I've got a problem here when I clicked on PIN, P-I-N, right?
It's PINS.
Oh, that's what the problem is. The wrong number's in there, so I got to put in the right. So P-I-N-S?
Correct.
Okay, because I was saying there's no fundamentals on Pinterest, but it was PIN. Well, we've got that. Isn't it amazing how one little letter can make a big difference?
Oh, it makes a huge difference.
I'll never get this one guy. He years ago, I think we got a quick make it. He put in the wrong symbol for a stock. He didn't realize a year later, and he lost half the money. He goes, "Oh, I was just off one letter." Makes a big difference. So
well, people did that with Zoom years ago. They wanted to buy Zoom, and they ended up buying some Chinese company named Zoom instead of Zoom Communications.
But I think that turned out good for him. I think.
I don't recall. I don't remember the exact numbers.
Let's look at Pinterest. Symbol P-I-N-S in the internet content and information industry. 5.6% shares float. That's okay. 96% institutional owned. PE ratio, very good. 7.8 versus 31.8. Price of sales, 3.8 versus 8.6. Price to book value, I'm going to look at tangible book value, 3.2 versus 62. And price of cash flow, 13.3 versus 21.9. And while PEG ratio, a hit all the way home here, 0.7 versus 12.1. So the valuation ratios and PEG ratio look very good for Pinterest so far. Earnings were up 6.7% of last year. Industry down 0.6. Sales were up 11.3. Not bad, but the industry was up 21.7. 5-year growth rate for Pinterest, 18% above the industry at 12.5. I'm liking what I'm seeing here so far. I just turned to dividend. They don't pay a dividend, but I like dividends, but not here, not a declining factor. Wow, current ratio and the quick ratio. So it's all liquid, 8.4 versus 1.9 for the industry. No debt on the balance sheet. Intangible assets, 2%, nothing there. We do see a net profit margin, 49%. Yeah, excuse me. I think I'm going to go buy this company.
Nice.
I mean, this is looking pretty good so far. 49% net profit margin versus 27.6. Return on equity, 41.2 versus 31. Free cash flow, well, this is the only thing I've seen a negative so far. 1.1 billion, not bad. But for some reason, the industry's at 55 billion on free cash flow. So that's
comparing, actually, Facebook's free cash flow sucks now because
CapEx. What was it, 160 billion in CapEx or something?
Maybe is it lumped in there with Google, Alphabet?
It could be.
Yeah, I mean, it's advertising.
Yeah. So, but other than that, I like what I see now. Depends on what we have going forward. What do you got?
Yeah, so current price here for Pinterest, again, their ticker symbol, PINS, P-I-N-S. It's $22.13, right near the 52-week low, $21.83, and the 52-week high here, $40.90. The 1-year return, not good, down 32%. The 5-year return, down 68%. I did look up the all-time high for Pinterest, $89.15 back on February 16th, 2021. So, I mean, you're getting this, I'm going to say, on sale here. I mean, you look at the valuations. This looks pretty darn appealing. You got to December 2026, estimated earnings per share are $1.89. We get a target sell of $31.37. You're getting this for under 12 times the future earnings. Not to mention, we will be shifting out here to 2027 soon, and their earnings growth looks pretty strong. 2025, you're looking for earnings growth of 27%. 2026, 15%. 2027, less analysts, but still 11%. So you're getting good growth and a low valuation here.
I don't really know, and I think your wife, Taylor, uses Pinterest. I think a lot of people use Pinterest. I have no idea what it is. I think you've explained it to me, and I still don't get it.
Yeah, I mean, the way it kind of works is you're going to put in your interests on there, and then you get kind of flooded with, not ads, but like design ideas. So right now, we're kind of making some updates to our backyard. So my wife, Taylor, she's got like all of these different design ideas that are now on Pinterest. I mean, you think about it, if you're a construction company, what a place to advertise, because you're just getting people and they click on it, and now they are directed to your website. So, I mean, it really has its place, I think. I think it's an interesting business model. I wish they paid a dividend. I think that'd be great, especially with their cash flow and the amount of cash on the balance sheet. But I think this has some staying power. And it doesn't have all the negativity that you get on normal social media.
No, it does not. And does it have... they make the revenue from what, advertising from
Oh,
the
yeah.
contractors? Is that all they get it from, you think? Or
That's one thing I'd be interested in is what types of businesses are advertising on Pinterest. Again, the contractors, that just came to mind. I wouldn't be surprised if like fitness companies go on there as well, because that's probably a big Pinterest on the platform.
yeah. All right. Well, gosh, I want to talk more about that, but maybe that could be a buy. There's a closing bell. Thank you for listening to Smart Investing Show. It is for informational purpose only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs, have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-224-0004. Again, that's 858-224-0004. Or go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. A lot of great information there. Thanks for listening. We'll be back next week right here on the Smart Investing Show with Brent and Chase.